So today we're going to talk about prices. Is it on yet? Yeah? A little bit? Okay, there it is. Okay, I can hear it. Um, Recall that when we started talking about macro, we were holding prices fixed, interest rates fixed, and didn't have trade. And so we've been gradually adding more things. We talked about interest rates last time, last two lectures. Today we're going to talk about how prices are determined. And you'll find here that once again, there's a process that reduces the effectiveness of both monetary and fiscal policy. So each of these things that we've left out, when you actually include them in the analysis, end up dampening the effects of expansionary policy, and so they have to be taken into consideration. This is the lecture that talks about how we have inflation. This is a topic that is on everyone's mind right now. We've had such incredible expansionary policy implemented in the United States that everyone's now afraid that we're going to go into a period of rampant inflation. I don't share that fear at this stage at least, but that is a concern, and we're going to talk about why that might be a concern. Many countries have actually experienced periods of tremendous debilitating inflation. Our country, we've been able to manage things so that we're able to not move into those regions, but many countries have fallen into them through inappropriate use of fiscal and particularly monetary policy. And we need to understand it to continue to be able to avoid it. Okay, so now the topic is called, this is aggregate demand and supply. That's the name that's given to how prices are determined. Remember when we talked about monopolistic competition? I told you that that was the second worst name in economics. Well, this is the first worst name. This is by far the worst naming convention of all in the history of economics. It has nothing to do with demand and supply, absolutely nothing. So the more you ignore those words, the better off you're going to be. What actually is going on here, the only way in which it's even similar to demand and supply is we're going to have a downward sloping curve and an upward sloping curve, but they mean very different things than demand and supply. What is actually going on is that there is two causations occurring, and those two causations operate in opposite directions and in equilibrium need to balance out each other. That's essentially what's going on. The first effect, or the first causation, is that when prices change, that, in a way we're going to show, changes the aggregate output of the economy. So actually we'll see that when prices rise, that has a contractionary effect on the economy. It causes the economy to contract and have less output. We're going to show the process by which that occurs. So that's one, is kind of a causation going from prices to output level. The other is a completely different process causing pressure in an opposite direction. When output moves towards full employment, we start using up our inputs, and prices of inputs start rising because some inputs start being in short supply. That causes output prices to rise. So as we move towards full employment, an increase in output can cause prices to rise. So you have both of these effects going on. Changes in prices cause output to change, and then changes in output cause prices to change. And those two need to balance each other out in a way that we're going to describe. And the place at which they balance out is where we end up having our level of prices and inflation. So let's look at the first one first. It is the more technically difficult, but you should actually have all the tools available. This is a nice place to stop for the midterm, stop right before this lecture, because all the tools you're going to need that we've learned so far are now going to be brought to bear to show you how you should already be able to determine that prices affect the aggregate output in the economy, how that happens. Okay, so here is our graph as we left it last lecture in equilibrium. We've got a quantity, our aggregate planned expenditures. That gives us an aggregate output. And at that aggregate output, we have a demand for money, and that gives us a interest rate, and that interest rate is the interest rate that then gives us back this planned expenditure. So we're all in equilibrium. Notice that we had done this at some fixed level of prices. I had said prices are fixed. I didn't say what they were fixed at, but they're fixed at some level. We weren't allowing prices to vary. So we can say that this is an equilibrium for those prices. And just to keep everything, on the same subscript level, this is output subscript 1 that's equilibrium with the interest rate 1 and prices 1 for those prices. Why did I put prices over here, you notice? Because that's the place we've already found out prices affect. As prices change, the demand for money changes. If the price of car goes up to 25,000 from 20, then you've got to pay 5,000 more for it. You've got to have more liquid assets available to be able to buy a car. So the way in which prices enter this system is through the demand for money, because our demand for money depends on those prices. So that's why I put it here. So now this is an equilibrium at one level of prices with an interest rate and an output that's associated with that. Suppose something happens. I'm not going to talk about what, but suppose something happens and prices rise. What's going to be the effect of that? We've already worked this through. It's just being more explicit on something that you've already worked out. Now, at a higher price, the demand for money rises because we need more money to be able to transact with higher prices. That causes the interest rate to rise. The interest rate rising causes investment to go down and savings to go up, which means consumption goes down, which then reduces planned aggregate expenditures and changes output to a lower level. So we started out with an equilibrium at all the ones. Then we said, what happens if prices somehow were higher? What that does then is change the equilibrium. It plays out with a higher interest rate and a lower aggregate output. We could have done this for any set of prices. I did it for P1, found the equilibrium for that. P2, found the equilibrium for that. We could have done it for any prices. There's all possible levels of prices. And in fact, we can. And then we can summarize the information in a device or graphical procedure of its own, which just takes the information from here and puts what's relevant onto another graph. And that's what this is. This is called the aggregate demand curve. Ignore the fact that it has demand in its name. What it is at a given price, what is the equilibrium output that's associated with that price? It's simply the information from the previous graph. This graph here shows how the equilibrium gets established and what the interest rate is that's associated with it. But in a sense, if you're just looking at aggregate output, that's what you're interested in. All you care about is what is P and then what is the output associated with that. So the information here can be summarized by graphing this P against this aggregate output. And that's what I did on the next graph. Similarly, at a higher price, P2, you get a lower level of output, Y2, and that becomes simply a second point on that graph. So the easier way to think about this is you go through that previous pair of graphs for every possible price. That gives you a set of points. You connect those points, and that gives you the aggregate demand curve. So what this curve actually tells you is the equilibrium output level associated with any given price. So if you have prices at a particular level, the system of interest rates and output will change until output becomes the level that's given here. So for example, if we had these prices here and we're somehow producing more output, we're actually at a point off of this curve, what would happen is interest rates and output would change until we moved back to this curve. So this is this is the set of points that are equilibrium in interest rates and output for some level of prices. So for any level of prices, there's some equilibrium output, and this curve gives you all such equilibria. So if you're not on this curve, you're not in equilibrium for output and interest rates given the prices that are being charged. What this tells us is that eventually we're always going to be on this curve, because eventually whatever prices are, the other things are going to adjust until we eventually get onto this AD curve. So that's the one direction that we have to take into account. We have to recognize the fact that equilibrium in output and interest rates will depend on prices, and hence will eventually end up on this curve. Now the question is where? We could end up at a very small level of output with high prices, or a very low level of output with low prices. Where are we going to be? That's what then brings the next graph. There's also this opposite causation that's going on that I described, and it's described in it's completely conceptually separate from what I've just discussed. As we move towards full employment, it would be nice if all inputs were in excess supply until all of a sudden we hit full employment and then we run out of all our inputs. That's essentially impossible. We start running out of some inputs early before we run out of other inputs, and so as we get closer and closer to full employment, those inputs that are starting to be used up, that we're putting stress in the markets, those input prices rise. Those input prices rising, as we've seen in the factor market lecture, cause output prices to rise. So as we move towards full employment, the fact that we're using more of our inputs causes those prices to rise, the input prices to rise, which then causes the output prices to rise. And as we get closer and closer to full employment, that becomes ever more stressful, ever more strong as a effect. So we have another curve that is called the aggregate supply curve, for God knows what reason, that describes this process, or more precisely, describes equilibria within this process. The best way to think about it is, if you're below this curve, if we're at any point below this curve, our output is so close to full employment that prices are going to rise. Okay? So anything below this, there's going to be a tendency for prices to rise. There's only going to be so much pressure on prices rise, so they won't rise forever. And if you're above this, then prices are so high relative to how far you are from full employment that prices are going to drop. So essentially what this curve does is break the graph into two parts. A set of price input combinations at which there's pressure on prices to drop because the prices are high given how far we are from full employment. Like here, we're so far from full employment, prices are too high there, there's going to be pressure on prices to drop. Below this curve, as we will have high pressure on prices to rise. We're close, given how far we are from full employment, the prices are too low and are going to be pushed up. And this is the set of points that which there's neither upward pressure or downward pressure on prices. So you can think of these as already, in a sense, equilibria points. Each of them is the price that can be sustained given the output level that we're currently at. So if you're at any given, say this output level here, read over here, that's the prices that can be sustained at that level of output. If we have prices that are higher than that, they're going to drop. If we have prices that are lower than that, we're going to experience prices rising. And this comes about through the input markets. This is important. It comes about because as you're moving closer to full employment, you're getting some inputs start getting used up, and there gets to be excess demand for them that causes the prices to rise, and then output prices rise. And that's what gives us this curve. So we've got two things going on. One, we have prices will affect the equilibrium output, that's on the AD curve, If prices change for whatever reason, then they're going to change equilibrium output. And here we find that for an equilibrium output, there's only one set of prices that are going to be sustainable. If we're not at those prices, then prices are either going to drop or go up. And so obviously what has to happen is both of those conditions have to be met simultaneously, which gives us equilibrium. The only way this is like a demand and supply is this is downward sloping and that's upward sloping. But beyond that, it has, it's important, has no relation to it. So the prices that we will have in the economy are the prices which, given the prices, we're at equilibrium output in our interest rate and output determination model. So we're on this curve. And given our output, we have prices that for which there's no tendency to rise or fall. And so both conditions are being met simultaneously. That's the equilibrium. So now let's look at what would happen if we're not at equilibrium, as always. Suppose we have high prices. High prices in our economy, when you work through the demand for money, that causes the demand for money to be high, which causes interest rates to go high, which causes output to be low because firms don't invest. So if we have high prices, that's going to cause the equilibrium output to be low. But at that level of equilibrium output, we're so far from full employment that those prices are not sustainable. We've got lots of excess inputs available, and input prices are going to drop because they're not being utilized. And input prices will drop, output prices will drop, and we'll move down the AD curve. So again, we always are going to be on the AD curve, and whether we're above or below the AS curve just tells us in what direction is our price is going to move. So here, we're at equilibrium output, given our prices, but those prices can't be sustained because we're too far from full employment. We've got excess inputs available that aren't being employed, and so those prices are not sustainable. Prices will eventually drop, and we'll move towards that point. On the other hand, get the other story going on in the other direction. Here, with very low prices, the demand for money is low, the interest rate is low, investment is high, and consumption is high, causing aggregate output to be high. And so we're here. But at this point, we have now gotten so close to full employment that those prices aren't sustainable. We're going to be experiencing an increase in prices because some inputs are being used up. And you know, you're going to run out of one thing prior to running out of another. We're not utilizing all of our inputs, but some of them are starting to be stressed out. And prices will rise. As prices rise, that causes equilibrium output to drop, and we move back on the AD curve back to that point. So essentially, we're always on the AD curve because that's what we've shown before. At a given set of prices, there's some equilibrium output. And that's what this tells us, what the equilibrium output is for any level of prices. But then we also have the second issue, which is what this curve is telling us, of whether those prices are sustainable, whether they will stay that way or not. And if we're above the AS curve, then we'll have prices drop. If we're below it, we'll have prices rise. So actually, I think of the AS curve as the easier way to think about it is if you're on one side or the other, it tells you which way prices are going to go. And if you're on it, it just means prices aren't going to change. So it's not, those points along it have no greater meaning than that. They're just what's going to happen to prices. So this is why we have price increases. Actually, let me talk about that here in relation to expansionary policy. What this then means is that any expansionary policy is going to cause prices to rise to an extent in addition to increasing aggregate output. Expansionary policy will cause the AD curve to rise. Essentially, at any given price, well, let's look at it up here. At any given price, this is the output at given level of government spending and taxation and monetary policy. If we increase government spending, decrease taxes or expand the supply of money at that given prices, we've already seen that's going to cause output to increase. So at the exact same prices, aggregate output's going to increase as an equilibrium in the output and interest rate markets. So all that aggregate, what expansionary policy does is move this AD curve out such that at any price, there's now going to be equilibrium output at a higher level of output. Okay, well, if that was all that was happening, that would be great. Expansionary policy, and these are the multipliers that we've been calculating so far. That as you increase government spending, this is how much aggregate output's going to increase after you account for interest rate changes and stuff. But now what we're going to find is even that is too large of an increase. That's not what's going to happen. Because what happens is at a given level of government spending, monetary policy, and taxation, we have an equilibrium here. If we engage in expansionary policy, if interest rates could somehow, if prices could somehow stay constant, what this graph shows is that we would increase all the way to here, which is obviously past full employment. But the way I've drawn it, if prices could somehow stay constant, we would move to that point. But prices don't stay constant, because as we get closer and closer to full employment, there gets to be pressure on prices to rise. And so prices move up, and we move to this new equilibrium. Essentially, part of the total impact of expansionary policy gets eaten up in a price increase. And in the graph I've just shown here, if you calculate this as your multiplier, you're going to be wildly off in how much actual expansion comes. The rest of it's going to be eaten up in pricing. So what this tells us then is we have to be very careful when we're doing expansionary policy to take the impact on prices into account and not end up where we're essentially just raising prices. And that's the fear, that we don't really solve any problems, we just raise prices. So expansionary policy creates inflation as well as increasing output. That's the conclusion here. But we can also think about when it's going to do it. And this is why I'm not so concerned about it now. If you're relatively close to full employment, do expansionary policy, it's mainly going to be eaten up in higher prices. Because this curve, AS curve, you can't go past full employment. It's going to have to start shooting up. And so as you get closer and closer to full employment, this AS curve has to start shooting up, in which case expansionary policy mainly brings about inflation without much increase in output. This is why we never really reach full employment. Eventually the prices eat it all up, and we don't. If we try to get closer and closer and closer to full employment, we're eventually just going to create more and more and more inflation and not ever actually get there. So this is the concern that people have now. We've engaged in tremendous amounts of expansionary policy, and the fear is that that's going to lead to price increases of the type shown here. However, the same graph can be used to show that if you're a long way from full employment, this curve doesn't go up so quickly. When you're a long way from full employment, you can engage in expansionary policy, and most of the policy gets translated into increased output. Here, if prices were constant, it would increase all the way to here, but prices do increase and will eat up some of it, but not a huge amount. This is closer to what it seems we're having now. We're having around 3.6, 3.9% inflation, which is a little high given where we are in the economy, but it's not dangerously high. The question now is, given that we've moved here, if we try to take care of our unemployment, which is still extremely high, our labor unemployment, not materials, then we might be starting to create more inflation. So there is a concern. This has to be considered. Okay, so this is how inflation happens. One thing, I don't know if I want to talk about it here. Yeah. Remember our age-old question? Why do we have equilibrium without full employment? If you remember the history I talked about in the first lecture, economists up till the Great Depression just assumed we would have full employment in equilibrium. That if we've got unemployed inputs, then prices, wages would drop, input prices would drop, and prices would drop and would move towards full employment. That seemed like a correct explanation for things. And then the Great Depression happened, and we brought about all this new theory that explains what's going on. This graph actually reconciles the two theories. As usual, theories are generally not wrong. How to put this? Great thinkers can come to a meeting of the minds is probably the best way to think about it. If the AS curve had a particular shape, the neoclassical economists who thought equilibrium would have to be at full employment would be correct. What if you had the AS curve as simply a straight line down here shooting up? So it's an L that is at the axis and then goes up. That would be a situation in which if we're ever below full employment, because we have excess inputs, prices would drop, and input prices would drop, which would cause output prices to drop. And so the AS curve, if we're ever above, if we ever have prices that are above zero, there'll be a tendency for prices to drop as long as we're below full employment. As soon as we reach full employment, prices will have to rise because there's nothing else to happen. You can't go past full employment. You're using up all your inputs. So if the AS curve were actually kinked like this, which is the way that the classical economists were thinking at the time, if there's ever unemployment, prices should drop, and that should cause output to expand towards full employment. That's the way they were thinking. If that were what actually happened in the economy, then they would be right. Oh, I got a phone call. Sorry. I yet to figure out how to turn this off. There we go. I think that's the first time in my 32 years of teaching, so I apologize here. How many of you would have been shocked if I had taken it? I would have been. Okay, so the classical economists were thinking that if ever prices were, if we ever have unemployment, that means there's going to be downward pressure on prices. That's just a market outcome. And so in today's way of examining what they were thinking, that is equivalent to saying the AS curve is like this. And in fact, the equilibrium would be at full employment. So essentially, we would have equilibrium at full employment if any form of unemployment would cause aggregate prices to drop. And aggregate prices only rise after we've reached full employment. So in a sense, they were correct under one way of looking at input markets. And then the question should arise in your mind, well, how come that isn't actually happening? How come if we have unemployment, like here, say we're at this point, this level of output, and we've got prices, how can there be upward pressure on prices, even though we're not at full employment? This is a question that truly is not answered theoretically well at all. Prices in a purely frictionless world would all adjust as inputs start being used up in one market. The prices there would rise, but then firms would substitute away from those to less used inputs, and everything. And eventually, as long as there was unemployment in any market, you would have a decrease in prices. The AS curve would be like this. In reality, it just doesn't happen that way. So you can think of the difference as being belief in pure theory versus belief in what actually happens. In reality, you start getting close to full employment, there's some pressure on prices to rise, and it just happens. We got to deal with it. And that's why we don't have full employment. This is very dissatisfying, that the age-old question of why we have unemployment and equilibrium is answered by an example of how you got to believe the real world rather than theory. It's a little bit dissatisfying for theorists. Nevertheless, this is true. This is happening, and this is why we start getting inflation before we're at full employment. Otherwise, if we had an AS curve like this, we wouldn't be having 3.6% inflation right now. We'd have negative inflation, but it doesn't happen. Okay, so we've got many answers to that question of why there's unemployment. Whoops. Now, I had talked earlier about as the AD curve rises because of expansionary policy, part of what goes on is part of the policy is eaten up in higher prices. And that has a bigger or smaller effect depending on how far you are from full employment to start with. That was talking about changes in the AD curve. What happens if there's a change in the AS curve? This is something that is exceedingly serious in an economy because we have no mechanism for actually counteracting the effect. Notice, if the AS curve rises, what that's going to do is cause both inflation and a decrease in output. And then if we try to engage in expansionary policy so as to counteract the reduction in output, mainly that's going to start causing prices to rise at a much further level from full employment than we were before. So trying to counteract this decrease in the supply curve, AS curve, by expanding the AD curve up, we're going to start getting high inflation much earlier than we were getting it before. This occurs because of different structural changes in the economy. The AS curve represents, again, if you think about it, it represents pressure on prices through the input markets. One thing that caused our AS curve to shift up and that we were, in a sense, very vulnerable to was the oil embargo in the 70s and then oil prices up till today. If you think of our economy as closed like we're currently doing and somehow oil prices are an external force, then what it means is if there's an oil embargo or high oil prices, that trickles through and starts causing all input prices to rise, all output prices to rise, even when we're quite a ways from full employment. So essentially, that's just an upward shift in the supply curve. Another way to look at it is if we were at equilibrium before the oil embargo or high increase in high oil prices, as soon as that happens, those increased input prices start causing output prices to rise, and this is no longer a sustainable price level. Prices are going to rise, and then when prices rise, you're going to have decrease in output, and then continue on up to the new equilibrium here. So we are extremely vulnerable to external shocks, and this is where hyperinflation occurs. If you had curves like this, it's obvious that you would quit doing expansionary policy when you're getting pretty close to full employment before you get hyperinflation. But countries that are extremely vulnerable to external events can get their AS curve shifted back so far that when they then try to engage in, get close to full employment, then they just get eaten up with more and more inflation. And the more they try, the more inflation there is. And they're still a long ways from full employment. This is the thing that has to be avoided, and it's exceedingly difficult because it's generally external. Can anyone think of something that has actually reduced the supply, the AS curve, over the years, moved it closer to full employment? Yeah. Deregulation? Exactly. A lot of regulation. I believe in regulation. We've talked about the need for regulation in many aspects of this course. So I'm not a non-regulation person. But many forms of regulation can create tremendous inefficiencies in the government, in industry, and cause prices to rise because of that inefficiency. And a lot of our deregulation has been getting rid of regulation that was no longer needed, that like trucking regulation, railroad regulation, that it had a purpose at one point in time and it no longer did. Getting rid of that has lowered our AS curve. That's extremely important. Another one, I hate to say it, is Ronald Reagan starting the movement to essentially remove the power of unions. You probably don't remember, but there was an air controller strike. The Union of Air Traffic Controllers went on strike, and he essentially ordered them by government decree that they had to go back to work. And that was the beginning of what's been now a long trend of unions becoming less and less powerful over time. You can believe that's good or bad, you know, everyone has their opinions on that, but one of the results of it is that it moved our AS curve back down, because unions tended to, when there started to be an increase in sales, try to get part of that money for their members. Why shouldn't they? They should. But that means that as you're moving towards full employment, it creates upward pressure on prices. When unions were less powerful, there's not that upward pressure, and so the AS curve allows us to move closer and closer now to full employment than we were before. So a lot of the policies that we need to be able to avoid this inevitable trade-off between inflation and getting closer to full employment is structural things that essentially remove or mitigate the upward pressure on prices that inevitably occurs when we move towards full employment, so that we can get closer to full employment without having that upward movement. Okay. Any issues? Questions? Yeah, hang on. Yeah. This is like an AS curve with unions powerful, and then with the unions being less powerful, the AS curve goes down here. Because what was happening earlier is that at a given level of output, say you're here, with the unions, it caused upward pressure on prices. Whereas without the unions, you get downward pressure. So the unions were taking care of their members, and that's a desirable thing. I'm not anti-union, but this is an effect. Great, thank you.